Let's kick off with a currency pair that, of course, is a key one to watch. The dollar-yen. Dollar hitting a fresh 3.5-month high against the yen this morning. And it appears that the Bank of Japan's further easing plans is what's weighing down. What are your views on the dynamics playing out there?
Morning. Yes, you're absolutely right that the Bank of Japan's intervention has, in the short term, seemed to be successful. You would know that they have intervened in the market on previous occasions to try and weaken the currency. Japan's still trying to recover economically from the impact of that earthquake, and the latest numbers suggest that that economy is still struggling. So, we are seeing this intervention action by the Bank of Japan, which in the short term has put the yen under pressure. But as we've seen with their previous attempts, these attempts to weaken the yen tend to only be successful in the short term, with medium-term movements suggesting that the yen is still likely to strengthen going forward.
So strengthening for the yen, we see the euro on a stronger footing this morning, and it seems like global markets are ignoring the Greek situation right now and preferring to focus on the fact that China is saying it will commit some money towards the eurozone problems. We've also had some supportive economic data out. In your view, what is driving the market this morning?
Well, you're right that the markets seem to be largely ignoring the situation in Greece and preferring to focus on the positive comments that came out of China to the effect that they would support efforts to bring the European debt crisis to an end by investing in those bailout funds. But arguably, this has been what the market has been doing all year. In fact, we've seen that since the beginning of the year, the trend in the euro has been firmly upwards, i.e. it has been strengthening against the dollar, despite the fact that Europe is, in our view, not much closer to a permanent solution than it was, say, 6 months ago. So this has really been a continuation of a trend that we've seen, that markets are largely ignoring the underlying fundamentals, economic fundamentals that prevail in Europe, and preferring instead to focus, I'd say, on more day-to-day matters.
As you say, and the sentiment of the day really driving the direction of the euro dollar. But overall, though, are you downgrading your forecast for the euro as we have heightened concern around confidence in Greek ministers right now?
Yes, I mean, our view has always been that the talks in the Eurozone tend to focus more on the symptoms of the problem rather than tackling the underlying causes. So until we see a move to tackle what we believe to be the underlying causes, i.e. the way that the Eurozone is constructed, we remain fairly skeptical that there's going to be a conclusion to this. And so we're still looking for the euro to lose ground against the dollar, possibly head to as far as 115 by the second or third quarter of this year.
115 is a lot lower than we're seeing it this morning. Let's focus in on the rand, opening up at R7.70 this morning. We've got retail sales numbers out today. Of course, we've also got Q4 GDP data, which will be key in terms of where the eurozone economy is. Your views on rand trading ranges for the day?
Well, as you mentioned, the rand did start off on the front foot, everyone focusing on those comments out of China. So along with most commodity currencies and commodity prices, the rand got off to a good start this morning. So as far as where it will go, as you mentioned, there's some event risk in the form of the data that comes out today. Retail sales, we're expecting a slight moderation in retail sales, but still a robust number, which we believe could be supportive of rand strength. The big wild card, of course, is going to be EU GDP, because while they're expecting a contraction, a worse than expected result as far as that data is concerned, could significantly shift sentiment, and that could be quite negative for the rand.
It seems though, overall though, foreigners are still buying local bonds, and that's been supportive to the rand. Just looking at month to date, we've had an inflow of 4.48 billion rand. Year to date, you've seen 10.44 billion rand. We're still sitting in a net positive position in terms of foreign inflows into the portfolio market. What's driving the continued search for high yield into specifically South Africa?
Well, it actually isn't specifically South Africa. We're seeing this search for yield occurring across a number of high-yielding currencies, and that's really due to the fact that there's so much liquidity in the market at the moment. We've had the ECB conducting their long-term repos, with another one due this month. We've also had the commitment from the Fed to keep their interest rates lower for longer, and expectations that they could launch another round of quantitative easing. We saw some quantitative easing recently from the Bank of England and Bank of Japan. So, of course, all this money has to go somewhere, and at the moment, it's looking, it's flooding into high yielding currencies, and we're seeing the rand benefit as a result of that.